the blessing is, of course, the Canadian founders get to come to the Bay Area and build amazing companies like Cloudflare. The curse is like they're not doing it in Canada. And part of the reason it's tempting for a Canadian founder to move here is because the ecosystem is here, not just capital, but also talent, right? I think there is a lot of value in being around other founders who are maybe just a click or two clicks ahead of you, who you can learn from versus just reading it on the internet. So I think we're going to continue to have, frankly, Canadian founders who choose to build their companies in the US. And I'm not sure if we should stop that. I think we should frankly embrace that.
Welcome back to Tank Talks. I'm your host, Matt Cohen, founder and managing partner of Ripple Ventures. And we've got another awesome episode today with Gaurav Jain, co-founder of Afore Capital, one of the most recognized pre-seed venture funds out there. On this episode, you'll hear how Gaurav became a pioneer in pre-seed investing and his journey as an engineer and product manager, where he was part of the early Android team at Google, helping them scale from under 1 million users to over billions. He even earned the Google Founders Award, which, let's be honest, isn't exactly something you pick up every day. But Gaurav's journey didn't start there. After building Polar Mobile as a student at the University of Waterloo, he went on to Harvard Business School, he joined Founder Collective, and eventually co-founded Afore, a firm that now manages over $500 million in assets and is laser focused on backing first-time founders even before they have traction or sometimes even an idea. Today, we dive deep into why he bets on the pre-traction stage, even when most LPs told him it was too early, the lessons he's learned from scaling Afore into one of the most respected early-stage venture funds in the ecosystem, and what founders need to know about raising a pre-seed in today's markets, especially with AI reshaping the game. Now let's jump into the tank for this week's episode with Gaurav Jain from Afore Capital. Thanks for jumping the tank today, Gaurav.
I'm ready. Let's do it.
You know what? We've been chatting for a while. You're in the tank here. But before we get started, it'd be great if you could share a bit about your personal background, where you grew up, what your childhood was like, and maybe a bit about your early professional journey.
I grew up in a tier 3 city in India, which at the time was only a few 100,000 people in the continent of, our country of 1 billion people is tiny, not so much in North America. Grew up in a small town in India, a big focus on education, as you can imagine, coming from the Indian subcontinent. Thankfully, I was decent in school and in STEM specifically. So that allowed me to then go into engineering. So my family moved to Canada, to Toronto when I was in high school. Went to University of Waterloo for software engineering. As you know, it's an incredible co-op program, more than anything else, where you work 4 months and you study 4 months. My first internship back when I was still a teenager, I was still 19, was to work at Research in Motion, now called BlackBerry. Of course, at the time, the company was doing far better than it is today. 20 odd years ago, at the time, it was probably one of the hottest tech companies. We were selling more BlackBerries every quarter than we had sold in the history of the company, to give you a sense of the growth. I remember my first day, they were like, here's a laptop. We don't have a desk for you. We don't have a cubicle, but we need code. So start shipping code, which is a 19-year-old man. I was like a dream come true. Anyway, did that, did a stint at Amazon in Seattle, one of my internships for Waterloo, worked at Morgan Stanley in London. I optimized for travel, as you can sort of see the pattern. And then I did an internship in Singapore in the mobile space. And kind of the story came full circle, having started at BlackBerry in the smartphone space, worked in Singapore in the mobile startups, and man, mobile is clearly the future. But I wanted to start something as opposed to, joining one of the companies where I'd interned. So with a couple of buddies from software engineering, we decided to start a company which became Polar Mobile, building, smartphone applications for media companies. Our first 2 customers were Canadian Business and Maclean's magazine. They wrote us a check for $10,000 each for those apps, and that got us into business. Raised multiple rounds of funding. That was my first exposure to venture capital as a founder myself. It's an interesting time. The business was doing well. This is 2008, 2009 timeframe, but the world was kind of melting on the other side. Sort of that dichotomy of trying to keep the company alive through all of that was interesting, to say the least. That then brought me to the Android team. In the early days, Google was facing an existential threat from iPhone, and it was pretty clear that increasingly consumers will access the web through their phones as opposed to their computers. And if all of us use iPhones, that's kind of a problem for if you're Google, because, Apple gets to decide what the default search engine may be. So as part of that team, we was given a blank check to basically say we need to have a horse in the race. It was a fun time. We went from less than 1 million total users on Android to about 1 million new users a day by the time I left. So kind of scale you only see a few places. Of course, today it's the most popular piece of software on the planet. It's like 3 billion people use it every day, which is kind of cool to see. 15 odd years later, I pivoted. I initially went to business school. As part of that, I wanted to run a bunch of experiments to see what I really wanted to do in my life. And I ended up meeting a couple of folks that were running a fund called Founder Collective. It was a $50 million fund one, kind of emerging manager, idea of sort of seed only funds or a stage focused funds. Joined the team as the first person, sort of the two founders, and then was there for 4.5 years. Had an incredible run, learned the business of venture firsthand from who I think are some of the best, if not the best in the business, and then spun out to start Afore about 9 years ago.
Oh, what a journey. I can't believe you were at the epicenter of two iconic mobile companies, both Android and Research for Motion and BlackBerry. I got to go back a bit though. You said you were obviously pretty good at school. Being good at school is one thing. Being able to incorporate yourself into the real world and being able to adapt to some fast-moving companies, to say the least, that must have been a big adjustment for you. How did you find yourself when you were put into this hot seat at RIM, being tasked with doing work, but also kind of learning what business was all about? Because let's face it, that's the best part about co-op, is like not actually doing the hard skills, it's the soft skills.
Yeah. You bring up a really interesting point, and honestly, that has been a transition, and I feel like it's a transition I'm still making because, when you go to school, the good news is like it's very clear what you need to do to write. It's like, here's the marking scheme, here's how we're going to judge you, here's, you got to get points out of 100, more the better. The rules are kind of very deterministic, if you may. And then you go to the real world, the business world, and it's very stochastic, right? It's like unclear exactly what it'll take to be successful. There's some, parameters, but it's largely open-ended. And I think that was definitely a transition. I remember when we were applying for our first internships, this is back at Waterloo when they didn't have a software for applications. You literally had to, believe it or not, physically take resumes and put them in these bins. And the bins had the name of the employer. It was a very, very visceral kind of experience, as you can imagine. It only happened for that first semester. Then they finally got JobMind, which is a software that powers the co-op system. Anyway, for the first one, I remember, Microsoft was the job at the time. This is we're talking 2004 that you could get. And I remember everybody told me, don't even bother applying for Microsoft. They never hired first year interns. But, you still want to use that one bullet as that,
You only have so many physical copies of the resume to put in the box, right? They limit you to 3.
Totally. So, but you still used one for Microsoft, and you put that in there, and you say a little, prayer. Point being, that's where I started at Waterloo. And by the time I finished at Waterloo, Microsoft wasn't the company to be at, right? Frankly, even RIM was past its prime. Fast forward movie today, Microsoft again, kind of the company to be at. I think that the learning from that was the real world is not only kind of stochastic as deterministic, but moves very rapidly. The rules keep changing, and you're only as good as in the venture world as your last investment, in the product world as your last product launch. And you cannot rest on your laurels. I think the mistake, when I've reflected a lot on what BlackBerry could have done differently, I think in some ways they became a victim of their own success. I remember, 2009, 2010, 2011, going to RIM's offices and talking about Android or talking about iPhone. And they were just I don't know what you're talking about. RIM is totally beloved device and it's so the future, at least for the enterprise, maybe not consumer. We don't really care about consumer. I think what was happening was if you walked around Waterloo for the longest time, people were still carrying BlackBerries and people still loved the product. But if you came to Silicon Valley, the world had started to move on. And I think you've got to keep iterating, you got to keep executing. And frankly, that pace of innovation has only accelerated with AI. We're seeing disruption happen faster and faster. And, in some ways, I've realized momentum is the only moat, right? It's how fast you can move and how fast you can improve yourself, your product. That is the only sustainable defensibility you have, which I think is very, very different, by the way, from the academic world.
That's
right?
Incredibly true. And I'm glad you mentioned the PTSD you have from seeing how slow, RIM was in terms of adopting, and then the opposite side of how fast Android moved. But it was because they were also fearful, right, of their own demise before they even got started. But let's go into some of your kind of early impacts. You said you started your first company, Polar Mobile, at the University of Waterloo. You raised pre-seed and then went on to raise some more, got caught up obviously in the global financial crisis. But how did that shape your views on being a first-time founder and developing almost founder empathy towards other founders?
Look, man, we made every mistake under the sun, right, that you make as a first-time founder. But I think there were two different aspects to it. One is the first-time founder mistakes you make. But also, I think at the time, the Canadian ecosystem was nowhere as developed as it is today. And part of it is obviously the ecosystem has come a long way in the 15 odd years, but also there's just so much access to information now, thanks to podcasts like yours or blogs and so on and so forth, that like even if you're starting a company in Waterloo or Toronto, you're not at the same level playing field as San Francisco, but you're like definitely the delta is not as massive. But at the time, there just wasn't that many resources. So like the people we would kind of, learn from were folks that had made money in like lumber or mining and but that's
It's
those are
true.
Canadian industries, right? Those are the rich people.
Real
So like those
estate.
are
Yeah.
exactly those are angel investors that we had that would invest in our company. For them, it was like actually diversification. It's like, look, I made my money in all this, and like, no tech, like let's Waterloo kids, let's give them some money, and obviously with money comes advice. And we were like, okay. And like so much of the business was oriented around a sales. It was oriented around like an exit, things that are like at some level, yes, it's true. But like what I've come to learn is like, man, in software, like it's got to be product led, like your product has to really speak for itself, has to stand on its own 2 feet. And yeah, sales and everything else and fundraising and exits will happen, but the product has to have a penetrating insight. It's got to be a 10xer. It cannot be a nice to have. Like all of those things I've really come to appreciate now in the context of like venture-backed software companies, which is a very different beast than every other type of business, right? Because if you think about it, yes, like the companies you and I are investing in are companies, sure, just like a restaurant is, just like a lumber business is, just like a real, but these are like extremely unique beasts, right? And they should never be compared to like traditional business, at least in the early days. Maybe at some point, yes, sure, when they're public or close to, but like in the early days, you cannot take what works in one world and apply it to the other.
Yeah, I mean, human beings are just programmed for pattern matching and pattern recognition, and there's no way to pattern match like a real estate portfolio versus like a VC portfolio. And also, yeah, setting something up for an exit is great, but we're betting on people and problems and solutions, not spreadsheets and not obviously financial records in terms of how their performance is doing in the first few years. And that's just a different mind shift. And the timing doesn't align with what traditional investments typically have in terms of their IRR return profile and things like that. So I totally agree with you. But in terms of sort of your early days of like you did HBS, then you joined Founder Collective, an incredible early stage fund making 26 seed investments, including Airtable and Cruise, before you left to co-found Afore at the age of 30. Thinking back to your first day in VC, what would you tell your younger self now that you learned after being in it for so much longer that you kind of wish you were able to learn the first day you jumped into Founder Collective?
The Malcolm Gladwell rule of like 10,000
Yeah,
hours, right?
I
To
say
get
the
good at
same thing,
something.
10,000 coffees.
It very much applies to venture, especially early stage venture, like the stuff that you and I do, which is like investing kind of idea, very early traction. And it's because so much of it is like judgment. It's like, I'm assuming I'm not a batsman and like a batter or whatever in baseball, but like probably what it feels like when the pitches are coming at you. I mean, I grew up playing cricket. It's exactly that,
Same
right?
thing.
The pitch comes really fast and you've got to figure out which ones to like let go, which ones to go for. And it's like a split second decision. Sometimes it feels like that in venture. And frankly, it just takes time to calibrate to like, I remember playing cricket, when you go out to the pitches, you just like, you feel like fish out of water, the ball's moving, all this funny stuff. But once you've been at the crease for long enough, the small cricket ball starts to look like a soccer ball. Your eye is so like well set that you're able to follow the ball so much better, probably very similar to baseball. And I think that's sort of what's happened to me. Now I've been doing venture for 13 odd years. I probably looked at like thousands and thousands of pitch decks. Because look, honestly, man, the first year I would look at a pitch deck and I would make a few mistakes. One, I would start to imagine if I was a founder, how I would run this company, right? So very much optimizing for the idea, right? More than the team, right? Not realizing, look, the team is what matters more than the idea because you're backing the team to then go after the idea versus backing the idea and then you got to find some team to kind of, orchestrate it. That was the one mistake. I think second is just like when you haven't seen too many ideas, you're not able to like calibrate and compare them to each other. Venture business is about less is more. We as a fund at Afore, if you look at 6,000 companies a year, as a team, we invest in like 10 to 15, maybe 20 companies, right? It's not to say like the ones we pass on are all garbage. It's not the case at all. So gradation, right? We try to pick the top 15, 20 because there's only that many companies we can support. But there's probably 100 that we come close to that we're like, would love to help, but just not going to get there. By the way, we make mistakes all the time. I think when my early days of venture, you start to sort of think like, okay, this could work. So like, let's chase it. It's like, no, this could work is not good enough. It's like, is this the one, that you're going to go all in for? And I think that is a switch I've had to make over time, is that the biggest constraint in this business is time, actually, not capital, right? You can always find more capital if you have access to good opportunities, but finding the time to find those opportunities, to diligence them, to support them, That's the biggest constraint. No matter how hard I work, I still have 24 hours in a day. That's my biggest problem. And hence, you have to be uber selective. And I think that just took some time.
That's amazing. I mean, it's the same thing we say to our team as well. We see 10,000 companies, but we don't call them companies. They're just people, right? They're people before there's even companies. And that's the people we track, just like you. But what I tell our team when they're getting started, I don't actually want to hear if you think this is a good investment opportunity or a bad investment opportunity for the first year of working here, because you have not seen enough to know where this thing is going to end up. All you need to do is say yes to every single company you can see and hear them pitch and listen to the founders. And then the team will end up getting together and see whether or not this makes sense as a viable idea, or the person is the right person to take it to the next level. And the other thing we say is the company idea you start with is most likely, almost guaranteed, not to be the company idea you finish with after the journey is done. So don't really listen to the idea as it's pitched today, but listen to the person. You know, you described meeting your partner, Anamitra, in 2012 as a key moment that obviously led to Afore. And, you know, you guys highlighted this gap around first-time founders being overlooked without any traction. First off, how did the two of you meet, and how did you guys come to this mutual understanding about the big gap in the pre-seed market before product founders were even being built in terms of companies?
Yeah. You know, my story, and probably it's true for a lot of people, is like luck, right? It's serendipity. You can't plan everything. The way we met, I was a scout for Foundation Capital when I was at Harvard. Now partner Anamitra, he was the first product manager at Twitter. So he was there as they scaled Twitter. He was hired by the founders. And then when he left Twitter, he was thinking of becoming a founder. So he joined Foundation Capital as an EIR. And there was a GP at Foundation that was hosting a dinner for all the scouts from different schools. They had brought us together, and then they invited the Foundation team, including the EIRs. And we randomly ran into each other, hit it off, and said, wow, we've both been product managers, and we're both not in venture, but are interested in venture. Like, let's stay in touch. And then he subsequently ended up becoming an investing partner at Foundation Capital, and I ended up joining Founder Collective. We started doing some deals together and got to know each other really well, and that kind of led us to spin out. But, you know, could I have predicted that, you know, random, you know, dinner would be so consequential to my life? No, it's impossible. And I think you have to just put yourself out there, and, you know, 9 out of 10 times nothing comes out of these things, but once in a while it ends up being consequential. You know, we had a shared passion for backing founders really, really early. We saw increasingly that seed managers, and frankly, I was at a seed fund, so admittedly, I was part of the problem, but would tell founders, like, you're too early for us, right? Go launch the product, get some traction, and then we can do a seed round. And the founders would often turn around and be like, so let me get this right. So I need money to get traction, but I need traction to get the money. Like, how do I solve this catch 22? At the point of venture capital was to break that catch 22. And all I could say was touche and, like, I don't know, check angel list. And when that happened enough number of times, we kind of looked at each other and said, holy shit, like, maybe this is what we got to be doing. Maybe we got to be investing a stage earlier than seed, when companies don't have any traction. They haven't launched a product. Maybe it's just an idea stage and nobody else wants to do it. That's great. We'll run with it. Didn't know what to call it. Pre-seed was this like fringe term that was being thrown around. Frankly, pre-seed at the time was a negative term. It was reserved for founders that couldn't raise a seed and hence would...
It's like a bridge.
Exactly, right? And we said, you know what? F it. We're going to like start a pre-seed exclusive firm. We're only going to do pre-seed, and we're going to raise the largest firm focused on pre-seed to make a point. The bar was pretty low on the size because nobody wanted to do pre-seed at the time. So, you know, 40 million was like going to be, if we could raise that, would be the largest firm focused on pre-seed. We were very lucky. We ended up raising 47. You know, we've been hyper-focused on that strategy for the last kind of 9 years. If anything, we've gone even earlier. Now we have a program called Founder in Residence, where we have founders come in and work out of our offices that don't have an idea yet, or are still iterating through ideas and still like very raw. Maybe the team is not fully formed yet. We have a FIRU, which is UTransfer University, where we literally have college students now. Our pitch to them is you could do a internship at a startup to know what it's like to work at a startup. We'll just fund you and go start your own company for the summer. You know, and if you go back to school, that's okay. We hope that you'll drop out because the company's doing well, but we want to go in earlier to support these folks because, to your point, it's all about the talent, the ideas. That's a dime a dozen. Now, some of our best companies have had like half a dozen pivots. We're in the business of finding the most impressive and high potential talent that is going to be a founder. Hopefully it's their next company, but it's a company after that. That's fine. We've got that patience. We want to be partners with the best talent in the world.
Yeah, and we'll get into a bunch of those opportunities that you guys have created inside the Afore family. But let's go back to that word you said. Too early is something you often heard when you were in the seed market. You know, seed rounds were ballooning, things were getting a little bit more frothier, and there was this too early mentality from the, obviously, seed investors telling the founders that. But I can only imagine the early days in raising that first fund, you probably had many LPs that were also saying it was too early. They were saying that pre-seed was too early for them. How did you convince your LPs and partners to even think about betting on pre-seed? Obviously, you were the founders, so they bet on you, I'm sure. But how did that kind of transition happen? How did you get them to believe in the model?
Doing something contrarian in the venture world is really hard. And I realized why. It's because when you go pitch something contrarian to an LP, the first thing to do due diligence is call their existing managers, right? And so we would go pitch an LP and we'd be like, hey, there's this opportunity on pre-seed, blah, blah, blah. Here's the data. They're like, oh, it's interesting. Okay, let me call my seed manager, see what they say. Pick up the phone, call the seed manager. Seed manager's like, pre-seed, that's a fad. That's going to go away. What is that? That's the deals we're not interested in. Like, those are bad deals.
They're good enough
why
to
would
be
you
seed.
Exactly. Like, why would you ever fund a fund to just, invest in the bad stuff? It was really hard, to be honest, right? And I think the top-down diligence would never get you to invest in a fund like ours or believe in pre-seed as a category. But I think when you do bottom-up diligence, what that means is when you talk to founders, right, to say, hey, like, there's Afore guys are talking about pre-seed. They're saying that you got to pitch for seed, and seed manager said no, and you were forced to be creative and find capital. Is that true? Is that really happening? And like, if there was a pre-seed fund, would you have funded it? The LPs that did second level of diligence, which by the way, there are only few that are willing to do that level of work, but the ones that did that level of work said, you know what? It's not in the data yet because there are not enough pre-seed funds. There's not enough like pre-seed.
We don't have angel investors.
Exactly, right? But like, we are seeing there's something happening here because we've done the raw diligence. We went to the source, right? Not to the intermediary of that data. So look, man, it was hard. But what's ironic now, 9 years later, is some of the fund of funds that passed on us because they did not believe in pre-seed as a category. Not us necessarily, but pre-seed. They're like, we just don't think this will be a category. Now have a pre-seed strategy and have like pre-seed fund of funds, which is like, it's just incredible to see. Obviously, it's both a blessing and a curse for somebody like us. The blessing is like the categories become a thing. The curse is now there's a lot more competition. And of course, these fund of funds are funding other pre-seed funds, which is all net great. As long as the category wins, the founders get served well, we're happy. But look, man, we had to do a lot of work in the early days. We sat down with Crunchbase, PitchBook, everybody to say, hey, look, you got to break out pre-seed as a distinctly separate round from seed. Because right now you bundle everything into seed. So like the data, of course, like it just doesn't support pre-seed because it makes it sound like not many founders raise pre-seed, or these successful companies that are like really successful now, it seems like they never raised a pre-seed, even though like, I don't know, let's say Airbnb, raised a few $100,000 before they raised a big round. Like that is pre-seed, whether you call it exactly that or not, and like a whole bunch of other companies. So as we worked with them to break out the data, that's when things started to become more obvious that it is a different stage altogether, just like seed and Series A is a different stage. And then what that led to is the founders started to clue in, because then the founders would be like, oh, okay, I should call this round pre-seed, not seed. I should go talk to pre-seed firms. They'll be more amenable to my stage and pitch. And that starts to become a self-fulfilling prophecy because this business runs on founders, right? That is the oxygen that runs the venture business. Once the founders bought in, game over.
I mean,
right?
Gaurav, I owe you a thank you. You did the hard work. You did the heavy lifting for guys like me. But I will say it's so interesting to hear you say you had to go through in terms of the education part, the collecting of the data. We don't announce a lot of our fundraising rounds at the pre-seed because a lot of these companies are still in stealth. So we don't want to have this kind of eye on them too early when they haven't even launched the product. They're still with design partners, as you know well. Lack of data was a problem for you to overcome. The knowledge gap on what this clearly meant, and also the founders as well, was something you had to make them aware of as well for this reason to even exist. But what we've also been hearing is that fund of funds are now realizing that the 30% reserves they had for their seed or Series A managers that they were going to use for the direct follow-ons, they can't even deploy that capital into growth equity investments because there's so much competition, or those seed managers don't have, the same pro rata major investor rights. And they are saying they wished they would have taken that 30% and put it all into pre-seed so that they would have had more ownership in the breakouts to have a better chance of getting direct access to those companies. And that's sort of changing the model. But look, it's worked for you obviously quite well. You've got now 500 million of assets under management, including your recent fund 4 raise, I believe, 185 million across all these market shifts. And you've had some pretty strong breakout names that obviously, we know well in Canada, like Neo Financial, the old Skip the Dishes founders that you rebacked. They've raised Series D, BenchSci, Modern Health, High Touch. You've seen a lot of these companies over 9 years go from pre-seed to, pre-IPO, call it. What have you seen the biggest shift though, as dedicated pre-seed players like you are now, more abundant in the ecosystem, and how this plays out across the founders and companies' journeys over a much longer period of time?
Yeah. Yeah, I think some things have changed, some things have not changed, right? So what's changed is obviously there's more players in the ecosystem funding at pre-seed, which obviously leads to more competition. But I'd say net, what hasn't changed is the opportunity is still very much there. There's many, many founders who are looking for pre-seed. And arguably the number of companies getting started has only increased. And we're seeing with this with AI, I think that number is going to skyrocket because the barriers to entry go lower. There's just so much opportunity to create value. And frankly, what we're seeing is folks that might have been founding engineers in the past are now choosing to be founders. So I'd say the opportunity has kind of grown for all of us while there's more competition. And frankly, we like competition. It keeps us honest and keeps us on our toes. And we keep iterating, just like going back to where we started. You've got to keep executing. You're only as good as your last great investment you did. And it just helps us keep on our toes. Like, we feel very excited about the prospect of pre-seed. In fact, even more now than ever, there's a term that's been thrown around, seed strapping, right? This idea that companies raise a little bit of capital to run a bunch of experiments. Because see, what happens at pre-seed is like, you need some money to be able to quit your job and support yourself, or, drop out of school, whatever it is. You need to maybe hire a couple people to be able to like build the first version of the product, maybe a little bit of money to run some go-to-market experiments. And that is, let's say, anywhere from $1 to $2 million. You still need that capital. But then once it starts to work, the beauty in these AI companies is that they scale very rapidly and they're very efficient as they scale. In fact, we did this analysis across our 200 companies, some obviously AI native and some not. What we found was that our AI native portfolio gets to $1 million in revenue twice as fast and by burning 1/5 of the capital than our pre-AI companies. So we think there may be sort of increasingly this chasm, if you may, in terms of venture, where you need some capital to get started, and then you can delay when you raise your growth capital, which maybe historically might have been a Series A in 12 months or 18 months. We feel excited about the prospects, and we only see kind of more companies getting started, which is exciting.
Gaurav, please don't tell more people about this inside scoop that we both have about this, seed strapping. It's just too good to be true. I mean, we have the exact same anecdotal data as well. We have companies that are crossing $1 million in ARR faster with only raising $1 million initial capital. It is the most unbelievable time that we are seeing to be early stage pre-seed investors like yourselves. And when I hear your name is in the mix on a deal, I want to work harder too. I think competition is great. And we've obviously co-invested together and work well together. And that's what this ecosystem needs. But listen, this is an industry of missed deals and missed opportunities, but also fast moving market shifts. How are you guys developing this instinct to know when to basically pursue a pre-seed opportunity as the market is shifting rapidly, next AI wrapper, next model comes out? And how are you trying to layer that in with the founder in residence program with even pre-idea founders? Do you want people to be a pre-idea founder when they think they're a pre-seed founder? Or do you think people who want to be pre-seed founders on an idea are ready to go and you want to let them free? Like, how do you try to kind of collect them into the right moment in time for them to make the call?
Yeah, as you and I were talking about this stage of investing, and frankly, the fact that we're now going earlier, it's all about investing in people, right? And what we're really trying to underwrite is a person more than the idea. So we try to quickly triangulate, the team and the person we're talking to, right? And I'd say things that I look for, to me, number one is growth mindset. Is this team able to iterate? Number two is pace, right? Is this team going to iterate quickly? And number three is grit, right? Is this team going to walk through walls? The number one and two are easier to diligence, frankly, than number three, especially given that, we don't have the luxury of getting to know the teams over weeks or months. We have to sometimes make decisions quite quickly. But I think you can get a pretty good sense. Does this team have the ingredients of what it takes to find the right idea and then build a company around it, and at least get it to like a certain, first base, let's call it. And then from there, obviously the team will then have to kind of reinvent themselves and to go from strength to strength. And some of that is just hard to know a priori. When I've looked at the founders that I've invested in that have been very successful, you look back 10 years later, you're like, wow, like you are not the person I invested in. You have grown and evolved so much in wonderful ways that frankly, the way you now talk and pitch and whatever, if you had done that back in I would have gone all in, right? I would have put way more money, but like you were not as confident, not as bold. I think you're almost like betting on some of that personal growth. But I think you can figure out at least like, hey, is this team going to, be able to get to that first base? And for companies that are a little bit farther along in the sense that they have an idea, that they've done some customer development, then we can underwrite the idea as well, or at least a general zip code to be able to say there is some market pull. in the short term, right? Because what we have found is if there is market pull in an idea and the team has those three ingredients that I talked about, they can usually make something of it, right? And of course, like how big it can be is still a question mark, but at least they'll get to like something meaningful. Ones that don't have that market pull or just for whatever reason are just not able to move fast, they don't even get to first base. And those are diligence failures on our part, that we should avoid as much as we can. But being able to predict which ones are going to be the billion-dollar businesses at the stage we invest in, we think it's still pretty hard.
Yeah, it's pretty much impossible for sure. But the opportunities for founders these days has never been more abundant for pre-seed programs, founder in residence programs, obviously Y Combinator. How do you guys think about the value add approach and why founders should choose to work with Afore either at the FIR program, at the pre-seed program, or any other options versus, what some founders are saying, get the 500K from choose your accelerator, incubator program, studio program, whatever. What is the Afore model that makes sense for most founders?
Some of that it stems from like my experience as a founder, first-time founder. I think there's building a company, like not to dissimilar to other stuff in life. There's a lot of art, there's a lot of science, right? And I think there's a lot of things that you can learn from other people's experiences and other people's perspective, especially with something like building a company. There's so many subjective calls you have to make. There's no black and white, like a deterministic marketing scheme, like on what customers are looking for, and I think that's where we can be really helpful, or any other investor, frankly. And our differentiation is as follows. Number one, we built a concentrated portfolio. So we're not trying to spray and pray and invest in hundreds or thousands of companies, because we believe with a concentrated portfolio, we can actually roll up our sleeves and be helpful to you, understand your nuances, your context, and be there for you when you need us, right? So it's concentration. I think second is like stage focus, right? So we only invest at this stage. A lot of, frankly, players at this stage are multi-stage funds that are writing small checks to buy a call option, right? To track the company. We think that's not great for a founder, because as a founder, you're not writing a call option. It's not like you have a job in the day and you're doing this on the side, right? To see if it goes anywhere. So why should you partner with somebody who's basically investing to see if it kind of, goes anywhere? For us, this is all we do, right? So the first check we write, it better work, right? It's not a call option for the second check. We pay what we think are fair terms, right? For that stage. I think a lot of times with these accelerators you refer to, like the price you're coming in at, the best founders we find are subsidizing the ones that are maybe not as strong or don't have as strong of a network or connections or resume or whatever the case might be. And we're able to do bespoke deals, right? Figure out what makes the best sense for you as a founder, for the stage you're at, the market you're at, and so on and so forth. So I think the combination of the above makes us, we think, a really good fit for a certain kind of founder. Again, they usually tend to be earlier in their career. So these are not second, third time successful founders, right? Even like the founders of Skip the Dishes, for example, they were kind enough to let me invest in Neo, but like it wouldn't be at the same price or the same stage where I invested in Skip, because they had made the money themselves. They could fund their business and they knew a lot more. So, those tend to be like non-core almost investments for us, right? Where we still have the relationships that will back the founders, but our core strategy is to back the founders of Skip the first time around, right? And then help them build that business. So we find like for that kind of ICP, there's still, we've kind of carved out our niche. There's still competition for sure, but there's frankly plenty more companies for us to be looking at that we're not able to get to fast enough that we miss, than so much about like losing deals to competitors.
Yeah, it's so interesting to hear you say that the great founders who go to like a YC are subsidizing the other maybe lower level founders because they all take the same structured deal. And people don't talk about that often enough. It's like this 200 company batch or however many it is per batch. You're right. There's like the top 10% and then there's the bottom 90%. And everybody talks about the 10%, but everyone has the same deal. So what you're saying is having a bespoke offering and non-pre-structured offering is what founders want and makes sense for what they believe their worth is and what you believe you can bring to the table as well as a fund. That makes a lot of sense. So thanks for sharing that.
Yeah, I mean, bespoke only works if you do it at a small scale.
Right.
Right? You cannot do bespoke at scale.
No,
That's
you can't do
an
1,000
oxymoron,
companies bespoke.
right?
It's impossible.
Exactly. So I think you have to pick a lane, right? Different folks have picked a different lane. For us, the lane we've picked is just, it's okay to be concentrated. It's okay to be, we take on more risk, obviously, by being concentrated, right? But we think that's the right thing for the founders.
How many portfolio companies do you guys have now, would you say?
So we are not investing out of fund 4. Each fund ends up having about 35 to 40 odd companies. So we're probably at somewhere around 150 or so across the 3 funds. We're in the middle of fund 4, fairly concentrated. And then we take 3 years to invest in a fund. So in any given year, we're investing in 10 to 15 companies as a team, right? I've got a team of 7 investors now. The base has gone up a little bit because now we have 7 investors, but it's still a fairly concentrated portfolio. Each one of us is only doing a handful of investments a year.
Okay, so let's go back in time. What would you have done differently to better prepare for scaling to Fund 4 and maximizing your impact on the ecosystem? Now know what you know.
Yeah, I think the one thing we probably should have done differently is brought on more investing talent a little bit earlier in the life of the fund. And look, some of that's like hard to know at the counterfactual, but I think we were trying to balance building the core kind of foundation of Afore, the culture, the ethos, like what do we stand for, and then balancing that with like bringing other people to the team. When we just expand, especially the investing team, like the dynamics change and there's more, like you slow down because more people now need to be brought on up to speed on investments you're looking at. But I think we maybe took a year or two longer than we should have because just there's so many companies to meet at the top of the funnel. And some of that is like, it's impossible to know without meeting the founder,
It's
right?
so
It's impossible to
interesting.
know from a deck, which ones are interesting, which ones are not. So I just think more people, that are Afore trained meeting founders is better for us. I think that's probably one piece that we feel could have done differently. I mean, there's a whole lot of obviously anti-portfolio companies. I think, we added the concept of non-core a little bit too late. Frankly, we were too dogmatic with Fund 1. Part of it is, we sold this thesis around pre-seed, right?
Right.
Just like we talked about at LP. So we were super like, if it's not pre-seed, then we're out. So to give you an example, the founders of Ramp, right? And they're LPs in one of the first investors in our fund. And the reason they're LPs in our fund is because my co-founder, Anamitra, he was on the board of their previous company called Paribus that was acquired by Capital One. It was like a smallish outcome, wasn't huge, but we knew them really well because he was literally on the board of their previous company. When they found out we were starting Afore, they became LPs pretty quickly. And then they were pitching us right when they were getting started. But I think the first round itself was at like 25 posts or something. It was like something high. But it was pre-seed, right? Pre-traction, pre-revenue, all that kind of stuff was pre-seed. But the price was like, if you do this deal, our LPs are going to be like, wait, hold on, are you doing seed investing now? Like, I thought you told us pre-seed. So we're like, Eric and Kareem, we like you, man, but like, this is off spec for us. So thanks, but no thanks. Probably a several $100 million mistake at this point. So like, stuff like that we've screwed up on, where we were just too dogmatic. And I think part of the maybe course correction is like Neo is a good example where, that wasn't a pre-seed in terms of the price that we paid initially, even though again, the stage of pre-seed, but we said like, these are founders I have incredible respect for. They're going to build an amazing business. We've got to be a part of it. And obviously we found ways to help them. There's tweaks we made to the strategy as we've kind of, learned ourselves from mistakes we made.
Thank you for sharing that. It makes me feel a lot better about my first pass on Drata when they first got started. And I had a revenue threshold of something. Basically, when I had our second fund, we promised our LPs we would not invest in pre-revenue companies during the beginning of COVID. And they came obviously with a very pre-revenue product or idea almost. And we had to pass on the very first call. So that was a tough one as well. So I'm glad we both have that to share in common with our stories. But you know what? It's interesting to hear you say about the expansion of the investment team because right now, we're seeing more and more, solo GPs getting started and getting funded and spin out. So how do you think about that in terms of like what you've learned in terms of like, there's too much to cover. We need to cover 10,000 companies a year. We should add more investment talent, which you have by Fund 4, but you've got solo GPs now, which are raising pretty large first-time funds. And they're also basically staying as an individual investor.
Yeah, like I think the nice thing about venture business is there's no one right way to do the business, right? And part of it is founders have unique preferences and needs and desires, and they find kind of the investor that works best for them. The biggest constraint I've learned in this business is our time. Right. It is a services business, right? In a services business, time is what you're selling ultimately. And almost money is like just a vessel, right? Really give them your time in one way or the other. The solo GP strategy works for certain founders for whom maybe they don't care to work as closely with their investors or maybe their repeat founders, or for whatever reason, they don't find as much value from the support that the fund can provide. Versus, I think the strategy we've taken is like, look, there are ways we can be helpful to the founders. And now we've got a 7-person investment team. So it's not just about like covering more ground, but also we can help you by having a larger network, right? When it comes to follow-ons, hiring people, all kinds of things. Like just in the last 2 months, 12 companies in our portfolio have raised $200 million in follow-on. And vast majority of that is introductions we made, right? And by the way, there were many other introductions we made that led to a term sheet that obviously like the founder didn't end up taking. So like there's probably much more capital there that we brought onto our portfolio because of the network we built, because of the team size, right? And the presence that we have and the fact that people recognize our brand. And our portfolio on aggregate, I think has raised about $3 billion or so after us. 62% has been introductions we made. right? So again, we can be very consequential to the business because of the impact we can have, which is somewhat driven by the size that we have. The follow-on investors now recognize our brand, right? Because when they say, oh, it's an Afore company, it doesn't mean they'll invest, but at least they'll take it seriously. That, of course, comes from like having
Totally agree.
more size. So look, it's the pros and cons. I'm not going to say there's one or right or wrong. I think we feel like for our ICP, this works well. But at the same time, we've also chosen not to be a 500-person shop like Entrecent, right? We don't have a massive operating arm because we explored that and we realized at this stage it's really hard to just parachute in GTM support because it should be founder-led sales, not like sales driven by your investor. And even recruiting to some extent is like hard to do because you should do a network-based hiring because you should bring on your friends as the first few engineers. So anyway, there's certain decisions we made to keep the size. We still think on a relatively small size, but not too small.
Gotcha. Yeah, no, I appreciate the transparency there. It makes sense. Different shapes and different sizes in this entire industry. Want to just get your thoughts on the Canadian ecosystem. Obviously, you started here in Waterloo, a lot of Canadian investments. We have produced amazing tech talent like yourself, but we still are struggling to build that kind of globally VC recognized brand in Canada at the earliest stages. What do you think needs to change to get more people like you? Obviously, we're trying to emulate what you've done here in Toronto and Vancouver to unlock more opportunities for founders to have optionality. Or do you think Canada punches above its weight in innovation and there's enough early stage capital out there that we don't really need to have its own Canadian dedicated pre-seed fund?
Yeah, look, I think we could definitely do better in Canada, but I'm not sure how much better. And let me unpack that. So I think we could do better in the sense that there's incredible tech talent coming out of places like Waterloo, UFT, and a few other schools in Canada. So if you believe in kind of what I believe, which is the talent is sort of the nucleus of this whole ecosystem, I think Canada has that. And we've done incredibly well in both investing, not just in Canadian companies, but frankly, Canadian founders moving to the US and then building incredible companies. And there'd be many companies, even outside our portfolio. I think the founder of Slack, for example, and others that are Canadian, or Cloudflare and so on and so forth, right? So, but I think we could do better in the sense that the talent is already in Canada. How can we keep them there? And some of that is like risk capital, the right kind of mentorship, right at that early stages of figuring out how do you run these experiments, build a team and so on and so forth. But the reason I say is like there's only so much that can be done is I think part of the challenge for Canada is the US is right next door, right? And it's relatively easy. The current administration is maybe trying to make it a little bit harder, but it is relatively easy to come here and build a company, right? And I think that's a blessing and a curse, right? Because the blessing is, of course, the Canadian founders get to come to the Bay Area and build amazing companies like Cloudflare. The curse is like they're not doing it in Canada. And part of the reason it's tempting for a Canadian founder to move here is because the ecosystem is here, not just capital, but also talent, right? I think there is a lot of value in being around other founders who are maybe just a click or two clicks ahead of you, who you can learn from versus just reading it on the internet. So I think we're going to continue to have, frankly, Canadian founders who choose to build their companies in the US. And I'm not sure if we should stop that. I think we should, frankly, embrace that because a lot of times those folks then go and build their engineering teams in Canada, right? And now, especially given Shopify and other stuff, there's lots of engineering talent. And hopefully some of those people will then choose to stay in the country as opposed to moving out here once they're done their stint. So I think in general, that's good for the ecosystem. But look, having more risk capital that's seen it before, that stage focus, I think that'll be good because a lot of people also want to stay back, right? They don't want to necessarily move to the US for a whole host of reasons. So is that market underserved? Absolutely.
Yeah, I know. I appreciate the transparency. I think we have the same thing in our portfolio. We have the R&D engineering product teams being, headquartered in Canada and the go-to-market, sales ops teams being based in the Bay Area or in New York or somewhere else. And it totally works. I think it's a great thing for both of us to have that kind of overlap between the two markets. Obviously Afore emphasizes on giving founders, a safe space to iterate, even pre-idea founders. How are you thinking about backing founders now in this AI revolution we're seeing and how fast things are changing? Are you seeing companies pivot even faster during these like 8-week boot camp programs that you are offering in the FIR program?
Yeah, totally. I mean, we've seen the pace of pivots skyrocket in this AI world.
What's the wildest pivot you've seen? We've had one go from like database optimization to like 24/7 healthcare services.
Is wild in the sense that like we have a company started off in speech therapy software, now doing like customer success softwares and all kinds of flavors. And I think the reason for that is a few things. One, I think the average age of the founder, at least the one we're seeing, is getting younger and younger. Right. Part of it is because the folks that go into college are AI native. They grew up with LLM. They're very comfortable. A lot of the research is being done in college campuses. So like a lot of folks are dropping out or spinning out of school and starting companies. As the average age goes down, what that means is that these folks have less and less domain expertise, right? Historically, like when we started Afore, the prototype of a founder would be like 2 to 3 years at a company, pick Uber, right? And it's like, hey, look, I saw something at Uber. It doesn't fit the roadmap of the mothership. I want to go spin out and do something, right? I mean, this is how Apurva, talking about Canadians, right, started Instacart. Was at Amazon, saw the opportunity, started Instacart. Or how, Ben Silverman, who's at Google, started Pinterest. That was sort of the typical kind of sequence. But now, as the founders are 18, 20, 22, like they haven't had that same level of experience. So they're coming in with like very open-minded on where the opportunities might be. And they're just like trial by fire, right? They're trying a bunch of different things and see what sticks. So I think that's one reason for it. The second is like, at the surface level, it might seem like there's opportunities everywhere, but I think once you start to like actually go down those opportunities, you realize for whatever reason it may not be a good one. So like you start with a certain hypothesis, you think it makes sense, and then you quickly have to pivot because it's just the world is moving so fast. I will get on a call with a founder and they'll be like, "Oh, did you see this like new Gemini 4.2 like that?" And I'm like, I feel bad because I feel like I should be on the top of things. I'm like, no, like when was it launched? And I'm thinking he's gonna say like last month, and you're so out of it. He's like, oh, 2 hours ago, it dropped on Twitter. And I'm like, too, like I don't know. I've been sitting in meetings the last 2 hours. Like how do I know what Gemini launched? Like, anyway, so like every day there's like a new launch, right? And like one-upping each other. So the space is moving fast. Opportunities are everywhere, but like not obvious where they are. So I think for a whole host of reasons, we're just seeing a lot of pivots, which I think is great. Frankly, we embrace that. We kind of joke that we offer pivot as a service almost, right? Because we're like, look, come here, and unlike a multi-stage fund that wants to sit on your board and like help you scale, we're going to help you pivot if that's what it comes down to, and like keep trying new ideas. And like if we don't think it's a bug, we think it's a feature, right? The fact that you're pivoting means like you're self-aware, you're like iterating, and you're going like, that was a good idea, but maybe not a great idea. That was a local maxima, and I got to go find global maxima. So anyway, we think it's a good thing.
My favorite thing is when a founder comes back after a couple of months and tells us they're pivoting, especially at like the pre-idea stage. I love it.
Totally.
And I say good for you. I hope the bloodshed wasn't too bad for you. And like, let's get back to work and find something else more exciting. So that's awesome.
100%.
I could talk to you forever, Gaurav, but I got to ask you, what inspires you the most outside of work? Like health, well-being, something else more important that's personal to you?
Honestly, man, it's my wife, who is a far more impressive, hardworking, and ambitious than I am. She runs her own business. She runs an interior design studio. The amount of passion she has for what she does, it's like I go back and I'm like, man, I got to be more passionate and work harder. The dedication, she's like one of those perfect founders you want to invest in, just like obsessed about like the mission and like what she's trying to build. And I learned a lot, frankly, just founder in the house. It's like a bit of a petri dish on like, what it's like to live with a founder. Not because sometimes it can become very academic as an investor on like, I was a founder, 15 years ago. And like, yeah, I talk to founders all day, but I'm not like living with them. And I think being in close quarters is inspirational.
That's awesome. Thanks for sharing that. I'm sure you guys have some great pillow talk. Before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast.
Yours.
Get out of here. Next.
Honestly, I don't know if I have one favorite. I listen to Harry Stabbings. I listen to Bloomberg. I listen to...
Like Matt Levine or something else?
There's two anchors. I forget the name.
Okay.
I do listen to Matt Levine, but I listen to him in the morning when I work out at 7 a.m. and his show on TV. But I have a bunch of favorites and they kind of like cycle through.
Next is your favorite newsletter or blog?
I've been following Alex Conrad, who left Forbes to start his new thing. Yeah, so I've been enjoying that. Just he's an upstart. He's starting something new.
The underdog now. I love
exactly. I love supporting underdogs.
Nice. Next is your favorite tech gadget?
It's got to be my 8 sleep, man. Speaking of my wife, it's kept our marriage healthy.
I have the same thing, but my wife thought it was too hard of a mattress to sleep on, so we had to put a thin cover on top of it, and now it dampens the coldest of it. So I'm cranked up to -10.
That's so funny because I sleep in -3 and she sleeps at +3. Because
exactly.
Before that we would go crazy, but now we're happy.
That's great. Next is your favorite new trend.
I'd say seed strapping. Too early to tell if that's going to the future. But
what's your craziest seed strapping you have seen in your portfolio?
Well, we have a company called Gamma, which is kind of building an AI native PowerPoint. They've raised a little bit more than seed, but they have way more than what they've ever raised in the life of the company in the bank today. So negative cash burn in the history of the business. They are well north of 50 million ARR now, cash flow positive.
Wow. Over how many years?
They started Gen AI. They started in 2020 or so, or 2021. So it's been like 3 or 4 years. years.
So a 3-year
But the
overnight success. I love that.
Yeah, but majority of the revenues come in the last couple of years, and they're in hyper growth mode. They've gone from 28 to now 35 people. But it's still anyway. It's still tiny, and it's just an
And
incredible.
you own
story.
more of the company, I'm sure, because of that. So that's awesome. Okay,
Totally.
next is your favorite book.
I have many, but I'd say if I had to pick one, the one I always go back to is Innovator's Dilemma.
Still relevant today.
Clay Christensen, and maybe part of it is it was my first business books that like just changed my fundamental way of thinking about business. But obviously the lessons are still very true. And I was very lucky to have him as a professor at business school.
Was it weird to hear Satya say Sundar say he'd never read it, Google, but he knew about
I didn't
it?
see that.
Yeah, I think it was David Friedberg interviewed him on the All In interview, and he's like, "Oh, like you've obviously read The Innovators." Like, no, I haven't read it actually, but I heard of it. He's like, "You are the Innovators Dilemma right now."
Yeah, exactly. Like, you better read it tonight, man.
It was
before it's too
crazy.
late.
Last but not least is your favorite life lesson.
Man, I have so many, but I'd say the one that comes to mind is that you connect the dots looking backwards. When I was young and, in college and stuff, I was so caught up on like trying to predict the future and exactly what that path will look like. And then you realize you just gotta like take the next best step, and maybe you can think 2 steps ahead, but it's hard to think 10 steps ahead, and you just gotta embrace as life unfolds.
Fantastic. Well, thanks for jumping the tank today with Gaurav Jain from Afore Ventures.